computer. The message. Welcome, guys. Chapter 10, financial accounting. We are getting close to the end of this course. Isn't that a good feeling, guys? It's a tough course, but if you've stuck this far along with it, you're gonna do well. This week, we are going to highlight on the stockholders' equity section. And we're going to talk about something new this week called Treasury Stock. And then we're just going to get into a little more detail regarding the accounting of issuing stock, buying back Treasury stock, and declaring dividends, recording dividends. Just more details in this stockholders equity section. So we do know that the stockholders equity section, as it appears in the balance sheet, and also we are aware that there's a statement of stockholders equity. Oops, sorry guys. Kathy, I'm teaching. I'll call you back, honey. Okay.
Okay, I'm so frustrated.
Okay. Sorry, my sister. So there's a statement of stockholders equity that really goes into the detail, but we know that stockholders equity has, we've talked about two components, common stock, and it has retained earnings. We're going to bring in a new component called treasury stock. So paid in capital is going to be the amount, the common stock, the amount the stockholders have invested in the corporation. Then the retained earnings section is the amount of earnings the corporation has retained. Remember, retained earnings equals net income minus dividends since the inception of the corporation. Treasury stock is the corporation's own stock that the corporation has reacquired in the public. Here you see an example of the stockholders equity section for American Eagle Outfitters, and it shows you how treasury stock is a contra account. It has a negative balance against the other aspects of the stockholders equity section. So there are tons of advantages of the corporate form of ownership. There are a couple negative benefits or negative attributes, but for overall, this is a positive type of entity. We know through an organization chart, and this is the chart of pretty much all corporations, the stockholders own the company. It's stockholders who own it, and the stockholders elect a board of directors. So the board of directors speaks for the stockholders, and they find and hire a chief executive officer. It's the CEO, chief executive officer, that runs the company. And he hires his top management to assist him in running the company. But no, it's the stockholders who ultimately own the company. And stockholders don't run the company. They hire someone outside to run the company. Again, the CEO. Okay. Oftentimes, to begin with, many corporations need money. And the way they get money is by looking out for friends, close relatives, and people that they know associated with them. Then as they grow, they'll seek investments from venture capital firms, angel investors, and then ultimately an IPO, which is an initial public offering, is the first time they issue stock to the general public, which means they become a public corporation. So there are public corporations and there are private corporations. The public corporations allow for public investment on the stock exchanges, which ultimately gives more stockholders and more money. But they also are regulated by the Securities and Exchange Commission, which has many rules they need to adhere to. Examples of public companies: Target, Walmart, Apple. Pretty much most of the big companies are public companies, but there are some really big private companies. The beauty with private companies is they are not regulated by the Securities and Exchange Commission. Cargill is a huge private company and it's a very big company. Koch Industries, right, located here in the Twin Cities area, is also a private company. Now, when you own stock in a company, there are several different benefits that you may have. One is that you are going to have the right to vote. You have the right to receive dividends. And you have a right to the distribution of assets if, in fact, the company were to go out of business. So these are some of your benefits as a shareholder. The advantages, in my opinion, of a corporation far exceed the negative aspects of it. The beauty is when you are a corporation, the owners of the corporation, the shareholders, can only lose what they have invested in the company. They can't lose any more than what they've invested. And you can raise capital fairly easier than when you're a sole proprietor, and you can transfer your shares. With corporations come more taxes and a ton more paperwork, but it's just part of the necessary evil of being a corporation. So remember, guys, the primary advantages of a corporation are limited liability and the ability to raise capital. Disadvantages include more taxes. And what that means is at the corporate level, they're required to pay income taxes. And then when they distribute dividends to their shareholders, the shareholders also have to pay income taxes on those dividends. That's where it's called double taxation. So guys, let's look at this one. And I want everyone online to put your answer in the chat box. Which of the following is a primary advantage of forming a corporation? Anyone want to get online and just come out and say it?
See?
Yes. Increased ability to raise capital and to be able to transfer ownership. So we're going to now go to a next phase of this chapter and talk about the accounting for issuing stock. Now there's three dates, or there's three, excuse me, categories related to a company on stock. That amount that's been authorized by the company at the start of the company's formation, the amount of shares that have been issued, and then the amount of shares that are outstanding. So the authorized shares are the total number of shares the corporation is allowed to utilize at the onset of the corporation. Those shares are either issued or unissued. Those issued shares can be either outstanding or reacquired or repurchased by the company in the form of what we call treasury stock. So know that outstanding shares do not include the shares the company has repurchased in the form of treasury stock. You see that authorized, what's been available to sell. The issued shares are those that have actually been sold, and the outstanding shares are those only held by investors. That does not include the treasury stock, okay? People get this term par value really confused, but really, guys, the par value is just the number on the amount that might be shown on the stock certificate. It's what we call the legal capital per share of stock that's assigned to each share when the corporation first is formed. It has absolutely no meaning in relation to the market value of the stock. Students can confuse par value with market value. There's nothing related to it. And some stocks don't even have a par value. Some are issued with no par common stock. But we're going to look at how we account for stock with a par value associated with it, or if there is a no par common stock. So in this example, we see Canadian Falcon issues 1,000 shares of no par common stock at $30 a share. So we're going to debit our cash and we'll credit our common stock. However, if a company contains a par value, we're going to record it a little differently. We only show in common stock the portion of par value, and the excess goes into additional paid-in capital. So in this example, when Canadian Falcon issues 1,000 shares of 1 cent par value common stock at $30 a share, of course, we're going to debit our cash the same. But look, guys, our common stock is 1,000 shares at 1 cent per share. Then the rest, the entire extra, is credited to additional paid-in capital of $29,990. Does that make sense? Do you understand how you can see the difference there? Again, common stock and additional paid-in capital are absolutely stockholders' equity accounts, but we separate out the par value. So you guys, here's your first question, or second question. Company A issues 20,000 shares of $5 par common stock at $12.50 per share. The entry to record the issuance would include which of the following? A debit to cash of 100,000, a credit to common stock of 250, a credit to additional paid-in capital of 150, or a credit to additional paid-in capital for 250. What do you guys think? Any ideas? Anyone?
C.
C. Remember, the cash will be 20,000 shares at $12.50 per share. That will be 250,000. The common stock will be $5 is the par amount times 20,000 shares. And the additional $7.50 a share times 20,000 shares, or 150,000, will be credited to additional paid in capital. Okay, any questions on that before we move on, guys? I want you to understand it. Okay, how about this one? Or did I? No, I already did that one. Sorry, I thought there was another one happening. No, preferred stock is another type of stock, unlike common stock. And we're going to talk about how it relates to, how it kind of falls in the middle of common stock and bonds. Preferred stock is generally a stock, and usually we put it on the equity section in the balance sheet, but sometimes people believe preferred stock can have a component of a liability. Basically, generally speaking, I will say it's usually considered equity on the balance sheet, but usually preferred stock does not have voter rights. There's very relative risk to the investor, similar to bonds, whereas common stock, you have a higher risk, higher reward. But it is a stock, but they have various features that make it kind of a unique blend of equity versus to liabilities. Know that a preferred stock can have various features that can make it convertible, which after a period of time, it can convert to common stock. It can be redeemable based on a fixed price set out at the start. And the most interesting to me is it can be cumulative, which means it can, if it's cumulative, it will receive the dividends from years that have not been paid in a future period. So we'll show examples of what we're talking about here. So in this example, assume a company issues 1,000 shares of 8% $30 par value preferred stock and 1,000 shares of $1 par value common stock at the beginning of 16. No dividends were paid in 16 or in 17. But in 18, the company decided to issue $10,000 worth of dividends. Well, in that case, if in fact the preferred stock is considered cumulative, they will get dividends in arrears, dividends for 2016 and for 2017, 2,400 each period. And now in 2018, they'll get their 2,400. And then whatever remaining will go to the common shareholders. That is a really cool feature. Now, when the preferred stock is what's considered non-cumulative, they don't get those dividends in arrears. So in 16 and 17, they didn't issue dividends. And then in 18, they decide to issue dividends. The preferred shareholders don't get those dividends in arrear. It's non-cumulative. So they only get the $2,400 in dividends in 18, and then the remaining get to go straight to the common shareholders. So please be aware of the difference between cumulative preferred stock and non-cumulative preferred stock. Any questions on that, guys? Okay, so remember, guys, preferred stock has both features of common stock and bonds, but generally it is listed in the equity section of the stockholders' equity. Some preferred stock that might be mandatorily redeemable can be so similar to debt that those companies included in the bonds payable section of the balance sheet in the liability section. I personally have not seen that, but it can be a factor if they are forced to be redeemable. Let's look at this problem. I'm going to give you probably 4 minutes to try to attempt it on your own before we go over it. Nathan's Athletic Apparel has 2,000 shares of 5% $100 par value preferred stock. The company issued at the beginning of 2017. All remaining shares are common stock. The company was not able to pay dividends in 2017, but plans to pay dividends of $22,000 in 2018. Assuming the preferred stock is cumulative, how much of the $22,000 dividend will be paid to preferred stockholders and how much will be paid to common stockholders in 18? And then if it's non-cumulative, how would that make a difference? Give you just a couple minutes here, okay, guys? Okay. Anyone need some more time? How's it going? Anyone? Anyone? Okay, so let's look at it. For the cumulative stock, they're going to get 10,000 for this 2017 year, and then 2,000 for the 2018 period. And then the remaining $2,000 of that 22,000 will go to the common shareholders. For non-cumulative preferred stock, 17 is gone. It's just a done deal. There is nothing else that will the shareholders will be able to get if it is non-cumulative. So they will get dividends for 2018, but the remaining then will pass to the common shareholders, who will be able to distribute 12,000 amongst themselves. Okay, does that make sense? So guys, which of the following is a primary advantage of owning preferred stock? Is it preferential voting rights, tax deductibility of payments, preference over common stockholders in the distribution of assets in the event of a dissolution, or higher risk to investors than owning common stock? What do you guys think? Perfect. C is correct. It is going to be preferential treatment if there's a dissolution to the common shareholders for dissolution of assets. Now, you know, all of the liabilities would have to be, of course, paid first. Now, here is kind of one of the main focuses on this chapter, is dealing with treasury stock. Remember, treasury stock is when a corporation's own stock is purchased by the corporation out in the public, so it's been reacquired. They buy their own stock back for a variety of reasons. Sometimes they have free money, money that they don't want to pay dividends out, so they're going to use it to buy up stock. If they purchase stock, it will help boost up those shares that are outstanding. And oftentimes, well, if you think about it, if there are less shares out in the public, it is going to increase their earnings per share. So usually, and employee ownership, stock ownership plans is also a beneficial way in which they will purchase the treasury shares to get the stock they need for compensation. Students can confuse the purchase of treasury stock with investments in another company. Remember, an equity investment is the purchase of stock in other companies, and that gets recorded as an increase in assets. Treasury stock is the repurchase of a company's own stock, and we record it as a reduction in stockholders' equity. It is not an asset because a company cannot invest in itself. So when a company purchases treasury stock, in this case, Canadian Falcon repurchases 100 shares of its own 1 cent par value common stock at $30 a share. We will debit our treasury stock for $3,000, and we will credit our cash for $3,000. So the debit is a contra account to treasury stock for $3,000. And of course, we need cash in order to do that. Now, when you purchase treasury stock, it will reduce the stockholders' equity section. Do you see, before the treasury stock was purchased, our stockholders' equity section was sitting at 100,000. After the treasury stock was purchased, since that treasury stock is a negative balance, it's a contra account, our stockholders' equity was reduced to $97,000. Now, we purchased treasury stock, and now we're going to reissue that treasury stock we purchased to the, we're going to sell it for $35 a share. you know, we originally purchased that treasury stock for 30 bucks a share. So we need to know what that original price was when we repurchased that treasury stock. So when we then reissue the $30 treasury stock, we can only credit the treasury stock up to what we purchased it for at 30 bucks a share. And any difference, any increase or decrease will go into additional paid-in capital. We need to zero out the treasury stock and then show any difference, either an increase or a decrease, needs to be keyed into additional paid-in capital. Okay, so here, as you see, we had treasury stock that we reissued to the public. So after we reissue it to the public for the 3,500, you see here our treasury stock zeroes out and our additional paid-in capital increased by $500. So our new stockholders' equity balance after we reissued or repurchased, resold, that treasury stock is now at 100,500, the stockholders' equity balance. So what if Canadian Falcon reissues the 100 shares of treasury stock for only 25 bucks, but knowing we purchased it for 30 bucks? Again, we'll debit our cash. We're going to zero out our treasury stock at 30 bucks because that's what we had purchased it for. And we debit our additional paid-in capital, basically showing a loss on the sale of that treasury stock. Remember, guys, we include treasury stock in the stockholders' equity section of the balance sheet. We show it as a reduction in stockholders' equity. When we reissue treasury stock, we report the difference between its cost and the cash received as an increase or a decrease in additional paid-in capital. Okay, guys, we've got an exercise here. Finishing Touches has 2 classes of stock authorized: 8%, $10 par preferred, and $1 par value common. The following transactions affect stockholders' equity during 2018, its first year of operations. On January 2nd, we issue 100,000 shares of common stock for 35 bucks a share. On February 6th, we issue 3,000 shares of 8% preferred stock for 11 bucks a share. On September 10th, we repurchased 11,000 shares of its own common stock for 40 bucks per share. And then on December 15th, we reissue 5,500 shares of treasury stock at 45 bucks per share. Give yourself about 4 minutes. Attempt these, guys. If you attempt them, it helps you to see if you're getting it or not. Okay? Okay, guys. Can anyone help out with the first one? January 2nd issues 100,000 shares of common stock for 35 per share. Okay, so basically, the first one is we debit our cash for 3,500,000. We only credit the common stock for the par value. That's 100,000. And we credit the additional paid in capital for the difference. Okay, the next one says February 6th issues 3,000 shares of 8% preferred stock for $11 per share. Here we're going to debit our cash, credit our preferred stock for just the par value, and then we credit additional paid in capital for the difference. Then September 10th repurchases 11,000 shares of its own common stock for $40 per share. Then what you'll do is we just debit the treasury stock and we credit the cash. Now, the next one's the tricky one. In December 15th, when we reissue 5,500 shares of treasury stock for $45 per share, we need to remember what we purchased it for. We purchased it for $40. So we need to zero out that treasury stock. We debit our cash. We show our credit to treasury stock at the $40 a share, and any difference, excess or under, will go into additional paid in capital. In this case, it's a credit to additional paid in capital. It's a gain on selling that treasury stock. Okay. Treasury stock has A, a normal credit balance. B, decreases stockholders' equity. C, is recorded as an investment. Or D, increases stockholders' equity. What do you guys think?
B.
B, decreases stockholders' equity. Excellent. Now, how do we go about recording dividends? Well, we know that companies get net income, and that net income is put into retained earnings. And if an individual invests in a company, they want to be able to receive a portion of the earnings of a company in the form of dividends. So earnings are retained in the company, but those paid out in the form of dividends are reduced from the retained earnings section of the balance sheet. So what we'll do in this case, when we pay out dividends, it's going to reduce the normal balance in retained earnings, which is a normal credit balance. So when we pay dividends, we'll be debiting our dividends, which is part of retained earnings. As you see here, in year one of this company, they started with $1,000 loss, which is a debit balance, which is not the normal balance. So we show that as a minus sign. In year two, there's a $3,000 net income. That $3,000 net income minus the $1,000 deficit ends up with a balance in retained earnings of $2,000. In year 3, if there's a $4,000 income and we pay out $1,000 in losses, that nets $3,000 in year 3. That $3,000 net positive plus the $3,000 in, the $2,000 in retained earnings gives us a $5,000 ending retained earnings balance. And then in year 4, the income was 10. We paid out dividends of 3, which nets 7. The 5,000 balance at the start of year 4 plus the 7 gives us a balance in retained earnings of 12,000. The balance of retained earnings equals all net income minus all dividends to date over the life of the company. Some students think wrongly that retained earnings represents a cash balance set aside by the company. No, 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 no. Know that retained earnings is just about the net income earned minus any dividends paid since the beginning of the company's existence. Now, oftentimes dividends are paid in cash. We'll talk about when they're paid in stock, but right now let's talk about what occurs when they're paid in cash. Now, the cash dividends can be paid quarterly or annually. Not all companies pay dividends. Oftentimes, growth companies don't pay dividends, but utility companies often do pay dividends. There are 3 dates we need to be aware of in paying dividends. There is the declaration date, the date they say, hey, dividends are getting paid. There's the record date, the date which those shareholders on record with the company will receive those dividends. And then there's the payment date, the date when the dividends are actually distributed. So in this example, when you see American Eagle, on December 4th, the board of directors decides they are declaring a dividend. That's the declaration date. They're going to pay a dividend of 11 cents per share. That's payable on December 28th. That's the payment date to shareholders of record as of December 19th. That's the record date. Know that on the record date, there is no journal entry that needs to happen. Journal entries will occur on the declaration date and the payment date. So on the declaration date, we declare dividends of $500 and a credit to dividends payable of $500. Then on the payment date, it's at that time we'll debit our dividends payable and we will credit our cash of $500. Okay. Know that the declaration of cash dividends increases retained earnings and increases dividends payable. The payment of cash dividends decreases dividends payable and decreases cash. Ultimately, there's a reduction to retained earnings and a reduction to cash. Okay, let's look at exercise 10.5. Again, try to look at it, attempt, I'll give you 2 minutes. See if any of it can make sense to you. Okay, so when a company issues no par stock, we're going to debit our cash and debit our common stock. Going back to the May 15th, when they issue stock with a par value, in this case of $10 par value, for $13 a share, and they're issuing 700, we're going to debit our cash. We'll credit common stock for just the par value. And then we'll credit our additional paid-in capital. On October 1st, we declare a cash dividend of $1.25 per share to all stockholders on record. It's at this time we're going to debit dividends, 6,700 shares at $1.25. We're going to debit our dividends and we'll credit our dividends payable. Now, at the date of record, there are no journal entries we need to do. But when the dividends are paid, it's at that time we will debit our dividends payable and we will credit cash. Okay. So guys, on which date would a company record a debit to dividends and a credit to dividends payable? Which date does this happen?
A.
A, the date of declaration. Exactly right. Thank you. Now we're going to take a moment and look at how stock dividends and how stock splits are recorded in the accounting records. A stock dividend is basically, instead of giving cash, we give additional shares of the company's own stock to its stockholders. Okay. A stock split is basically, it's such a large stock dividend that we just reduce or change the par value or the stated value on the stock. So if you own 100 shares of stock and you receive a 10% stock dividend, we're just going to get 10 additional shares. If you receive a 20% stock dividend, you're going to get 20 additional shares. Or if you get 100% stock dividend, that means you get 100 additional shares. Now, this 100% stock dividend could be a dividend or it could be a split. They'll tell you how it's going to be recorded as to how you're going to handle it. When it is a split, guys, there are no transactions at all. We're going to record. All we will do is reduce the par value per share and increase the shares outstanding. But when it's a stock dividend, it's a different story. We'll record a decrease in retained earnings and we'll record an increase in common stock. So the stockholders' equity section ultimately remains the same. We're going to take it out of retained earnings and transfer it over into common stock as it's recorded at par value. Here, guys, it's important to see when it's a stock split, nothing happens except the par value decreases. When it's a stock dividend, we'll increase our common stock section. We will decrease our retained earnings section based on the number of shares times the par value. Think of it as a piece of pizza. you have a piece of pizza. You can divide it into 4 pieces, or you could divide it into 16 pieces. But it's still the same pizza. We can make it look like we can get 16 shares out of it, pieces out of it, or 4 pieces out of it. But if we choose to get 16, each of those 16 is kind of less than what it originally was. Okay, but it's the same whole pizza. So let's look at this exercise. On September 1st, the Board of Directors of Colorado Outfitters declares a stock dividend on its 10,000 $1 par common shares. The market price of the common stock is $30 on this date. Record the stock dividend assuming a small 10% stock dividend, or 100% stock dividend, or assuming a 2-for-1 stock split. So if we are doing a 10% stock dividend, we'll basically take 10,000 shares times 10% times $30, the par value. Excuse me, the stock dividend, let's see, $30 on this. So the market value, I'm sorry, is $30 on this date. So that will be our debit to the dividends. We will credit the common stock for just the par value. But then the additional paid in capital is everything that the market value is above the par value when we record this transaction. If we're assuming 100% stock dividend, we're going to debit our stock dividend, 10,000 shares at just the par value, and credit our common stock. But if it's a 2-for-1 stock split, we don't record any entries. All we would do is reduce the par value in half. So guys, in this example, if a company has 1,000 shares of $20 par stock outstanding and issues a 2-for-1 split, how many shares are outstanding after the split? Wouldn't it be 2,000 shares?
B.
B, excellent. So remember, when we're dealing with the balance sheet, it's a snapshot. It's like taking a picture. It happens at a point in time and that's it. But the statement of stockholders' equity gives us a detail of what transpired during the year. It allows us to see what we started the period with, and then what happened during the year, and the ending balances in each section. And then we take those ending balances and transfer it over to the balance sheet. How does the stockholders' equity section of the balance sheet differ from the statement of stockholders' equity? What do you guys think? A, you said?
Yeah.
Excellent. Remember, the stockholders' equity section of the balance sheet is just a snapshot. But the statement of stockholders' equity shows activity over a period of time. So this example, now this one, I am going to make you do on your own. And I'm going to have everyone tell me what their total is here in the chat. United Apparel has the following balances in its stockholders' equity accounts on December 31st, 2018. Treasury stock is 850,000. Common stock is 600,000. Preferred stock is 3,600,000. And retained earnings is 2,200,000 with additional paid-in capital of 8.8 million. Prepare the stockholders' equity section of the balance sheet for United Apparel as of December 31st, 2018. I'm going to give you 2 minutes, 3 minutes. I'm going to run to the restroom real quick. And I want everyone to put their total in the chat box. Okay? You two are exempt. You're lucky. Okay. Did anyone put it? Okay, Alexis says 14,350,000. Me thinky? You guys are terrible. Okay. So if we look, we will see the preferred stock plus the common stock plus the additional paid-in capital plus the retained earnings minus the treasury stock gives us our total stockholders' equity. Okay. Now, as far as the ratios, you guys are going to do that piece on your own. as I said, in chapter 12, we'll cover all these ratios. Okay. Any questions before I go over the homework? You guys have any questions at all? Okay, anybody? Okay.